Welcome to Wealth Forge. Today, we're exploring a major financial crossroad that, honestly, almost every family is going to face at some point. We're talking about choosing between term and whole life insurance. Let's get right into it.
Okay, let's dive into this. Imagine you're sitting at a desk and you're offered two completely different life insurance policies. Policy number one gives you massive, heavy-duty coverage at a pretty low cost, but, and here's the catch, it only lasts for a set number of years. Then you've got policy number two. This one can last your entire life, and it even builds up cash value over time. Sounds great, right? But it usually costs considerably more money out of your pocket every single month. So which one do you actually choose? Well, it fundamentally depends on your family's specific needs, your budget, and exactly how long you need that financial safety net. We're going to break down both of these paths in plain, simple English.
Section 1. Why life insurance matters. Grounding the stakes.
At its core, life insurance does some serious heavy lifting. When the absolute worst happens, a grieving family suddenly hits a wall of financial reality. They've got to pay the mortgage or the rent, replace that suddenly lost income, and, figure out how to cover childcare and future education costs. Plus, there's managing any outstanding debts and paying for funeral and final expenses. It's a lot. And a solid policy? That's what buys a family the absolutely crucial time they need to recover financially while they're adjusting to a life-altering loss.
Section 2. Path 1. The case for term life insurance. Now, what's really interesting about this slide is the focus on a highly practical, option A mindset focused on lower monthly premiums.
So, term life insurance basically does exactly what it says on the tin. It covers you for a specific term or period of time. We're usually talking 10, 20, or 30 years. If the insured person passes away during this specific window and the policy is active, the insurer pays out the death benefit. Boom, simple. But if you outlive that term, the coverage just ends. It expires. You might have a conversion or renewal option, but actually scratch that. Renewing is usually way more expensive because, well, you're older. It's straightforward protection, no complicated cash value component, just simple, highly effective coverage.
Let's put this into a real-world scenario to make it concrete. Imagine a 35-year-old parent who just signed the papers on a 25-year mortgage. Their kids are little, and this family relies heavily on that parent's income right now. A 20 or 30-year term policy is like a financial force field around this family during these specific, highly expensive years when keeping up with mortgage payments and childcare really matters the most. They need substantial coverage, right? But they need it right now, not necessarily 50 years down the road.
And this brings us right to the budget. Let's say this same family sits down, runs the numbers, and figures out they can comfortably afford exactly $75 a month for life insurance. Depending on the insurer, that strict $75 budget is going to buy significantly more term coverage than it ever would for whole life. Because the monthly cost is just so much lower, option A, term insurance, makes it completely realistic to get an appropriately massive death benefit, enough to actually pay off that house and replace that income.
So you can start to see the clear advantages here. Term insurance is often the absolute best fit when your priority is a lower initial premium and getting the biggest possible death benefit for your hard-earned dollars. It protects you precisely when you need it most, like raising kids or paying off the house. It's temporary, straightforward coverage meant to handle temporary but massive financial obligations.
Section 3. Path 2. Understanding whole life insurance.
Let's look at the other side of the coin. Whole life insurance is permanent. It is designed to stick around for your entire life, provided you keep paying those required premiums. And unlike term, it usually includes this cash value component that slowly builds up over time. So who is this actually for? Well, if you have a specific lifelong need, say you're caring for a dependent with a long-term disability, or you absolutely want to guarantee a financial legacy or cover final expenses no matter when you pass away, you might consider whole life, assuming of course that you can comfortably afford the premiums.
But, and this is absolutely crucial, you need to understand the complexities here. Whole life means much higher premiums than a comparable term policy. That cash value growth, it's often really slow in those early years. And sure, you can sometimes borrow against that cash value, but those policy loans accumulate interest. If you don't pay them back, they eat into your death benefit and could even cause your coverage to lapse entirely. Also, and listen closely, because this is a huge point of confusion, having cash value doesn't mean your family gets a double payout. In many traditional whole life policies, beneficiaries receive just the death benefit, not the death benefit plus a separate cash value payment.
Section 4. Comparing your options head-to-head. And this brilliantly illustrates how these two paths stack up against each other.
Let's walk through this side by side.
On the term side, you're looking at a set period, like 10, 20, or 30 years. It's got a lower premium, no cash value, and it's just simpler. On the whole life side, you're trading that simplicity for lifelong coverage and cash value accumulation, but you're taking on a much higher premium and way more complexity. The big takeaway? Option A, term life, perfectly fits families who just need affordable coverage for temporary obligations. Whole life, on the other hand, fits folks with permanent financial needs who can easily sustain those higher premiums over the span of decades.
Section 5. Common mistakes to avoid. Let's make sure you don't fall into these traps.
Whichever path you go down, you've got to avoid some really costly financial errors. First, don't buy coverage blind. Actually calculate your needs, tally up the mortgage, the lost income, the debts. Second, and I can't stress this enough, never choose a premium that strains your budget. An affordable term policy that stays active is infinitely better than an expensive whole life policy you eventually have to cancel because it drains your bank account. Next, don't assume that cash value grows quickly, never treat policy loans as free money, and if you're ever replacing a policy, please never cancel your existing one until the new coverage is 100% approved and active.
Section 6. A simple way to decide. So the crucial point is really boiling this down to a few basic questions.
Step 1. Ask yourself how long you actually need the protection. If your mortgage is done in 25 years and the kids are out of the house, your need is temporary. Step 2. Ask how much coverage your family realistically needs to survive. If you need a massive death benefit to replace your income but your budget is tight, term coverage is what makes that protection possible. Step 3. Figure out what premium you can maintain comfortably month after month, year after year. Honestly, the best policy in the world is simply the one that fits your needs and stays affordable enough to keep active.
Which brings us to our final thought. Take a look at these options. Which matters more to you? For the vast majority of families trying to protect their loved ones from the absolute financial shock of a lost income or a huge mortgage, option A, a lower monthly premium through term life insurance, is the highly practical, responsible choice. It lets you get the substantial coverage you actually need right now without breaking the bank. But what do you think? I want to hear from you. Drop your answer, A, B, C, or D, down in the comments and let us know why. Thank you so much for joining us for this explainer. If this helped clear up your financial path today, please drop a like on this explainer, make sure you subscribe to WealthForge, and most importantly, share this with someone who really needs to protect their family's financial future. Remember to always take time to compare your options and speak with a licensed professional, as this content is for general educational purposes only. Stay focused on your goals, and we'll see you next time on WealthForge.